Welcome to another episode of Joshy K. I wanted to touch base about a couple of considerations when you're switching your primary residence into an investment property. So in Australia, one of the most common ways that people come into possession of an investment property is actually the home that they originally bought with their partner. They might have outgrown it now that they've had kids or wanted to move locations. They bought an additional home, and rather than sell the first home that they bought, said, well, why don't we just start renting it out? So I wanted to go through just some key considerations to think about when you are going to do that. Again, it's not an exhaustive list, definitely do your own research, but let's jump in and go through some options. I've got a little board behind me, so you'll notice I keep looking off to the side just as a bit of a reminder to keep me on track. Number one, so is your property in tenant-ready condition? Now, what I mean by that is it's very easy to go through your house right now, and you probably, even if you looked at the kitchen bench, you might have a bowl that's supposed to be a fruit bowl. It's actually filled with pens and blue tack and just bits and bobs from around the house, but you don't notice it. It's only when a guest comes through your house and goes, oh, that's quite interesting, that then you go, oh, okay, yeah, that's something that I haven't really looked at. So examples of that around the house could even be there's, fence palings out the back that are a little bit loose, or there's a squeaky board on the back deck that we all just know to avoid it and not sit on top of that directly, otherwise you might fall through. But really just thinking through, is my property ready for tenants to come through? Because if any of them get injured, I'm going to personally be liable for that, which could cost me a lot more in the long run. So doing a bit of a walk around your house, making sure that it's fully safe, ready to go. Obviously you don't want any plumbing leaks or electrical faults, all that type of stuff. Batteries are changed and all your smoke detectors, making sure you meet all those requirements. So that'd be the first one. All those things that are easy to ignore when you're living in the house, making sure that they're up to speed when you've got people renting the home off you. Number two, so always good to get your home valued as well as a rental appraisal before you start thinking about these things. I always like to be proactive when you're considering, investments. You don't want to be making decisions and then looking back and going, could we have structured that slightly differently to put us in a better position? So last thing I want people to do is not realize that they're only going to get X amount of dollars per week for rent where they thought it would be higher. And now they're actually having to come up with some of the expenses out of pocket, which eats into lifestyle as well. So again, that's where gearing comes into it. I have done another video on gearing, so positive and negative as well as neutral, but definitely getting your home valued. It can help for future capital gains tax as well. So assuming that you've moved into another home, you're now treating it as your primary residence for tax purposes, they're going to want to know any money or any dollar value that home's increased by since you rented it out could be subject to capital gains tax. So good to get a line in the sand and say we had it valued when we rented it out. Again, as well, just to make sure you know what you're going to get per week. So that way you can trade off with what other operating costs the property is going to have to see how much it's going to be out. So it's cash flow considerations. So in terms of expenses, many people don't necessarily know which expenses are tax deductible and in what way. So some expenses that you do, like lump sum, what's called capital work, so whether you're putting in a driveway, an extension, those are not expenses that you would typically claim as your tax in the year that you incurred them. Typically they go on a depreciation schedule or just get added to your cost base of a property. Again, there's so much more nuance to that. We're trying to keep this at a pretty high level. Whereas having a plumber or an electrician come in to make some changes, those things are typically tax deductible in the year that the cost is incurred. So just keeping that in mind with your cash flow as well, there is the tax consideration. Next thing on the list would be structuring. So what I mean by that is assuming that you've been proactive, knowing that this is going to be an investment property one day, deciding based on your personal goals and objectives if the property should be in your name, maybe it's in your partner's name, maybe it's in joint names. The consideration there is that any income that comes through, it goes in proportion to that ownership. Assuming that I own 100% of a home, and my wife doesn't, 100% of that income is assessable at my tax rate. The same is included with my deductions. So if I'm going to claim expenses or loan interest against my tax, I'm claiming against my marginal tax rate. So sometimes the consideration is, well, if I put it in my partner's name, will I make more in income than it'll cost me in tax? So that can be consideration there as well. Same thing with actual loan structuring. Whether you've gone principal and interest versus interest only, it depends on what goals you're trying to achieve out of the property. Also affects your cash flow. So that's another one to consider. Whether or not you have an offset account facility or a redraw facility, that's also really important. Again, I've done another video on the benefits of offset versus redraw and what considerations you should have. So definitely check out my channel. There's more information on that there. Private or professional management. So I've actually seen this go a number of different ways. So personally, my investment property that I've got, I professionally manage it. So it means I pay someone a weekly fee. They go out there, they inspect the property, they give feedback to tenants, they organise the lease agreements. It does come with money. Now, granted, it is tax deductible, but I just, being a financial planner, I'm always busy. I don't really have time to deal with plumbing issues or electrical issues. So, the real estate I've gone through effectively just has a threshold that, provided it's under a certain amount, they just deal with it for me, which is really good. I have got different people I've worked with in the past who have done things privately. And if you've got the time, sure. And if you know how to, write up contracts and make sure you're in the clear, perfectly fine. But it can be a lot of hassle as well. So you just got to decide which way you want to go with it. 6-year rule. So this is another one that, again, we're probably starting to get into the accounting space, but definitely do some research. But assuming that you rent out your house, as long as you don't make another home your primary residence for tax purposes, you can potentially treat the first home as your primary residence so that it's capital gains exempt for up to 6 years. Now, if you do that, the house that you bought is assessable for tax from the day you bought it. So it is something you need to be aware of. But if you're somebody who, maybe as a couple, you've just decided to travel for a couple of years, 2 or 3 years, you haven't actually bought another home, you've just been traveling in a caravan or renting out houses, that can be a really good option as well, so that you're not subject to capital gains tax. So again, that's pretty much the big summary. I've jumped ahead a little bit and covered off on the end there, but if you found that interesting, like and subscribe. Feel free to reach out. Happy to have a conversation. This is Joshy K, and I'll see you in the next one.